Hi, in this video, I want to talk a little bit about the perfect competition insurance market. So what does it mean for insurance markets to be competitive? Well, what it actually means is something very simple. It means that prices will be actuarially fair, which is the same thing as zero profits. So one thing to remember is that perfect competition implies price is equal to marginal cost. If that's the case, that means zero profit. So what does that mean with an example? Well, imagine that there's a 50% chance that you're going to lose 200 pounds. So this is the bad state, and this is the good state. And what that means is that let's say you have 1,000 pounds, you're in the bad state, you lose 200, or in the good state, you are with your 1,000 pounds. So 800 pounds here, 1,000 pounds here. Now imagine that an insurance company comes and does something very similar to offers you to pay you in the bad state for a premium. And remember how we defined that? We said like the price per insurance, let's say Q, is the premium per £1 of payout. Okay. And the question is, what is this premium such that it leaves the insurance companies with zero profits? Well, you might have remembered this and you might say, well, actually, that premium should be the probability of the bad state. And it kind of makes intuitive sense. So as the probability of the bad state is higher, you are going to pay out that with certainty. So you can imagine a situation where that probability goes very close to 1, 0.9999. How much do you charge for a £1 of payoff if you don't want to make any profit? Well, you pretty much charge very close to the £1 because you're almost guaranteed to give that pound back. Okay, but you can prove that. You could show that if we have more generally Q probability of a bad state, 1 minus Q probability of a good state, some initial wealth minus with the insurance company, what we're going to have is plus Q plus the payout, basically the insurance premium. Okay, here you're going to have to pay minus Q times the insurance minus Q times the insurance because you always pay that. And the question is, what is that Q such the expected payoff? Expected payoffs are equal to zero. Okay, so effectively what you want is we want that this is the, if you like, the loss to the insurance company because it's going to be negative there, right? So at net, you're going to pay more. So Q times, um, if you like this, I could write it this way. This is the loss to the company is equal to 1 minus Q times QI. Note that I dropped the negative here, right? Because this is an income that the insurance company is going to make. Okay, so this is the expected income. And this is the expected loss. Okay, and therefore you could, if you open up that, if you open up that bracket, I should have actually said here. So this is the probability of of the bad state, and I should not have used Q. Note that it's a little bit problematic. That's the premium. Okay, so I'm gonna knock out Q and use P instead. So knock out Q and use P instead. So P I minus QI. Q is still there because that's the insurance premium, but this is P. And you can convince yourself if you open up this, that the only way that this is true, P times I minus P times Q times I, Q times I minus P times Q times I. Note that everything else is the same. Same. What's the difference? P and Q. This thing here is exactly the same. Doesn't matter what P and Q is. So the conclusion is that P must be equal to Q. So what does it mean in an insurance company to be perfectly competitive? it simply means that you're going to have to charge actuarially fair. Why? Because the firms will engage in what is known as a Bertrand game, right? So if some company is making a profit, someone will come in and will start to kind of like lower those profits, right? So by offering a better deal, right? So if Q is higher, it's a worse deal. If Q is less, it's a better deal. And you'll steal the customers away, and you'll keep doing this until you make zero profit. So next time you hear perfect competition in insurance market, you should immediately think actuarially fair prices. Thanks for coming, and I'll see you on the next video.